Kev.
Oh, okay.
Well, we'll see what happens. I think it's just one recording.
Okay, that's fine.
Ah, there it is. We're live. Not live, but it's recording.
Okay, well, it's brilliant to have you with us, Peter. It's great to be able to chat, and got Patrick here as well, and myself, of course, Kevin Wadsworth. So Peter Grandich, Kevin Wadsworth, and Patrick Corinne, just having a very casual, general discussion about the markets, and just wanting to see what Peter's thoughts are on where we are at the moment and where things are going. So I think maybe I'll just share my screen, and we'll just get the discussion going. And I'll get a chart on the screen. Let's have a look.
Well, while Kevin's doing that, I assume everybody knows who Peter is, but maybe Peter, you want to use just a little bit of this time there to tell us a little bit of your background, just
Sure.
for the folks that don't know you.
Sure. Well, first of all, I'm glad to be here. I discovered you guys on Twitter. I have engaged and employed your work in my own work in the twilight of a 38-year career. I found it was a pleasant surprise, as I was just telling you before we started. I don't think people recognize how important technical analysis is. They've been caught up in the parabolic of all parabolic markets in general, and I'm just happy and glad that I have a chance to see the faces behind the work that I've been reading and have been found very, very useful in my own work. So, yeah, 38 years ago in the dinosaur era of the brokerage business, I started as a stockbroker without even a high school education, did everything through my career: money manager, hedge fund manager, head of investment strategy, spent 25 years in and around the metals and mining industry, spent 20 years working in the professional athlete community from a Christian perspective. And now in the twilight of my career, I work really as a business development person just for U.S. residents in a alternative to traditional financial planning group. And with that, I still share my views on markets and observations on Twitter, and discovered you guys, as I said, and it's been phenomenal work. And I would hope who's ever watching this recognize, if you can take someone, and there's nothing in this for me other than to commend two guys that are doing great work. And I really, really appreciate it. And I look forward as much as anybody else to what you guys put out.
Wow. Wow. I'm humbled.
Thank you very much for that, Peter. And I know myself and Patrick just really appreciate your words there. And I mean, we're technical chart analysts. We love what we do. Hopefully that comes across in the work that we do and the posts that we put on Twitter and on the website. And really, one of the things that I was just going to sort of discuss for a moment is just looking at how things are developing in precious metals markets. And I think you've seen this chart before. It's the gold chart that I did a little while ago. And back in 2019, anyone that's been following me will know that I was able to identify this breakout for gold with this nice arc formation. So that really was the time to get really interested in the gold and precious metals markets, a little bit like uranium was last year, and saw a very similar technical breakout. And gold has since more or less, well, I was going to say sort of doubled in price, but not quite. It's sort of got past $2,000 and has seen a nice sort of technical pullback, which may or may not continue for a longer period of time. We're at a fairly critical point here where price has been testing the edge of this golden arc, and I've sort of labelled some fairly key points of resistance and downside support in the sort of area where we are at the moment. So that's in combination with what's happening in the bigger picture, Peter, just you know, in the US economy and with things like the US debt and interest rates and all that kind of thing. Just wondering what your take was on this gold chart. And it's you know, from a technical point of view, it's clearly saying, you know, we've had a good pullback, and I guess it could turn north at almost any point, and we're looking for the technical breakouts to confirm that. But just from a sort of your experience point of view, what do you make of it?
So back in 2013, after 25 years, my primary interest was working in the metals and mining. I left, and by 2015, I wasn't even looking at the daily price of gold. But in 2018, I saw it, and if you can look at what you can just imagine what we don't see before that. And I said, oh, I think this market's ready to break out. And I did something that even caused a little disruption at home when I told the wife that I'm selling basically our entire portfolio and put it into bullion and mining shares. And because I did that, and I had stopped doing major financial networks and interviews of that nature, but the young lady that used to be at Kitco reached out to me, and I went and did an interview, and I said that I think there's a new mega bull market of gold born, and eventually it's going to take out the old highs. And I was never the $5,000 or $10,000 gold people, but I certainly believe that there's a lot of still left to the upside. And then, of course, it sold a pullback and then got back in a little early. And then, of course, I saw this chart of yours, and I can remember, and I used to deal with some of the, premier, when technical analysis was, and deservingly so, used in every day in financial networks and markets and commentaries. I was taught back then that, when you can get a source, cup, and handle, whatever people want to call it these days, it's usually, and you should expand on that because you're the experts, not me, but it's usually a very, very bullish formation. And so I used it. In fact, I used it in a Kitco interview, and I think that's when you saw that it was used, and how we ended up communicating and all. But so first, from a technical, I think you've obviously pointed out, you have to recognize there is a possibility that this could break down and all. But I just think when you combine, as we spoke earlier before we started recording this, I've always said to people from my earliest days in the business that you have to view technical analysis the same way a doctor comes in and looks at all the charts before he speaks to you about what may or may not be wrong with you. Without those indicators and those technical readings, he would have she would have a much more difficult time coming to a conclusion of what may or may be wrong with you, or which way you should go. Such is the case with technical analysis. So when I look at the fundamentals for gold, which I think are outstandingly bullish, the contrarianism to how so few people, I've used an empty boat kind of in photos to show how few people are truly interested. I mean, there still are a handful of permabulls that are always recommending gold, or people that sell gold, whether it's gold coins or mining shares, what have you. Outside of that, it's very hard to find people that are bullish. And yet, as you show, I think this chart clearly argues that the chances are strong that gold can still go a lot higher. And one thing I like to add also is, and I've lived off of this, especially the last half of my career, and I learned it from a gentleman from many, many years ago that was a Wall Street, a well-known person in the 70s, 80s, and 90s, Kennedy Grandich. And it's not how much you make that's going to separate you from the winners or losers, but how much you don't end up losing. And the reason I point that out is, even if we're not totally correct about the upside in gold, I think there's far less risk of losing 30 or 50% from here, which I think exists in the general equity market right now. So if nothing else, gold is the lesser of two evils minimally, but in my view, and I think with this chart, I believe you can be quite optimistic for its future.
Yeah. To your point, Peter, all we have to do is look at the historical Dow to gold or Dow to silver ratio, and we're at the bottom rail. We're at levels like last seen like in the 1930s, there before gold or silver started appreciating, because before 1970 gold was pegged, so it's kind of hard to know its true value back then. But we're so low, so you're right. So even if U.S. equities melt up some more and gold stagnates or goes a little lower, we're at the basement historically for commodities versus U.S. equities. So you're right. It's a low risk, higher reward proposition. And as chart traders, that's our mission, just to spot those skewed opportunities in our favor.
Absolutely, Patrick. It's all about probabilities, isn't it? And sort of trying to balance the probabilities. It's as a chart trader, it's seldom, if ever, possible to say that there's a 100% likelihood that the price is going to go up, or a 100% likelihood that it's going to go down. It's always something in between, and it's assessing those probabilities and trying to kind of use those to your advantage.
But before, I have a question for Peter. Look, I got in the gold when I saw it start breaking out against the Canadian dollars, like around 2018 or 19. Like, it was, the DXY was strong, but gold was already breaking out in Australian and all the other currencies. I wasn't there in 2011, 12, 13 that much. What was the sentiment back there, Peter? Like, the gold to Dow ratio was pretty high. So, but was CNBC talking about gold the first time it was around 1900? Like, how does it compare?
Well, when it was reaching the highs back then, it did get coverage, but I can give you a personal observation. 2011, I was invited to come over to speak over in London at a huge gold show. And everybody at that point, and I might have been part of it, I'm trying to remember exactly what my forecast was, but we all thought it was going to continue and go higher and higher. The bullish sentiment in 2011 was probably the most bullish sentiment since the day I entered gold or the markets back in '84. And of course, by 2013, it probably was one of the things that assisted me in leaving the metals and mining industry, because I took my second big loss. I share with people that I've had two major losses in my career, 7-figure losses, and the one in 2011 down to 2013 was mainly because of how loaded up I got. So yeah, the sentiment was extremely bullish, and that's interesting that you bring that up, Patrick, because the sentiment when we got to the highs last year with just ignored it. They didn't think it was anything of importance. So I think sentiment is on the side of the bull here. People either don't care or what I call hate it. I mean, if I may make one other point, Wall Street, the main financial service industry, sells stocks and bonds. So they're always going to treat gold like kryptonite. So you're not going to have people who depend on stocks and bonds to do well, to make a livelihood, to support something that really goes in the face of and usually moves in opposite ways of what they make their living off of. It's like I always said, you're not going to go to a Chevy dealer and hear him tell you, well, if you really want the best SUV, you got to go over to the Ford dealer. He's just going to sell you whatever the Chevy dealer has. So I just don't think gold has any real support. And then, of course, cryptocurrencies came along, and then certain spokespersons for them try to tie it that it was like the new gold. And so it really doesn't have a fan club. There's really not really any wide support other than, like I said, a handful of perma bulls and all. And if you're a contrarian, if there's still any out there, that's the other reason to be bullish on gold, because there's so few people that think it can go up compared to us, but they still think stocks and bonds can do, or things like cryptocurrencies and other things.
That's interesting. I've always looked at gold as something of a kind of a lifeboat, really. It's kind of there all the time, just doing its own thing, up a little bit, down a little bit. But then during times of crisis, everybody's running for the lifeboats, and suddenly you get these very sort of bullish spells like we saw sort of 2009 through to 2011, where the price of gold pretty much doubled during that period, and of course the gold miners and the mining industry did very well indeed. So yeah, it's an odd sort of thing, isn't it? Gold, you kind of wait around for ages, kind of getting frustrated, like that sort of period 2013 to 2019, 6 years of going sideways. And then, sort of 2019 to 2020, it pretty much sort of went up 80% in fiat currency terms. And now we're sort of going through a period of pullback and correction. Just talking about things being kind of at historical limits and things being stretched and sentiment and all that kind of thing. Just looking at the Fed funds rate, this is the overnight interbank lending rate. And I thought I'd chart it all the way back to the 1970s and before, and really just one clear charting pattern jumped out at me, and it's this kind of symmetrical triangle. And these tend to be pretty reliable in my experience, and they break up or down fairly decisively. But in this particular case, we're seeing a breakdown that, from a fundamental point of view, is very, very difficult to sustain. It's hard to imagine fundamentally how the Fed funds rate can carry on going down below sort of -5, -10, it's not sustainable. Sorry, Patrick, you
just want to mention that's the inflation adjusted. So those are the real Fed fund rates. So it's a Fed fund rate minus inflation rate.
Absolutely. So yeah, thanks for clarifying that, Pat. So what's happening from a technical point of view at the moment, to my mind, and Pat may sort of want to confirm this or not, perhaps, I don't know, is a false breakdown. You very often with these symmetrical triangles see a sort of a downside break like this, and it's we've seen it recently in sort of other key markets as well, interest rates and that kind of thing. You get these sort of false moves, and they're very violent, and we're just, as I say, to my mind at the moment, in this sort of particular inflation-adjusted Fed funds rate chart, looking at something that hasn't really happened all the way back to the 1970s. The price action has stayed nicely contained within this sort of symmetrical triangle, and a sudden break to the downside now is kind of shouting to me, with all my sort of charting experience and what I've seen over the years, that a very rapid upside, sort of almost violent reaction is likely to take place. And just wondering how that kind of ties in with any thoughts that you might have, Peter, along with the 10-year yield chart, which the US 10-year Treasury yield. This is the interest paid on the 10-year debt in the United States, which has been in a downtrend ever since that sort of period in the 1970s. We've seen ever decreasing interest rates and ever decreasing sort of yields. So we've become accustomed to this steady downtrend. It attempted a breakout back in 2018, and it was hammered back down. I mean, effectively, if the interest rates had carried on past this sort of 3% level to any great extent, when you sort of look at the mathematics involved, it would have been very difficult for the United States to carry on paying the interest on its increasing debt burden. But of course, we've seen the debt sort of increasing 14-15 trillion up to in excess of 30 trillion now, and that's not including the unfunded liabilities. So to my sort of very simple, I suppose you could say, simplistic mathematical way of looking at it, we don't have the ability to see the 10-year yield even rise as high as that now, because the debt has doubled. When you look at the debt repayments required, if we were back to 2.5-3%, the mathematics doesn't sort of add up. So we're kind of, I keep going back to this, and it feels to me like we're kind of cornered, because if the yields were allowed to rise, which is what technically should happen here, it's a descending wedge. This is it's a descending channel, slightly narrower at the bottom than it is at the top, and from a technical point of view, they break to the upside, with a target being right back where we started at the top. But of course, that I don't see how that could happen, because if you had interest rates up at 5, 6, 7, 8, 10%, the US would collapse under the weight of its own debt. But if we see these yields pushed down and kept down, then the real yield is going to turn even more negative, because of course we've got background inflation at 5% and rising, which is of course rocket fuel for gold. And of course, if the yields rise, it's rocket fuel for gold, because of the economic catastrophe that would bring about. So it feels like a kind of catch-22 position for me here, and I just haven't heard anybody explain to me how we get ourselves, or how the United States gets itself out of this. What are your sort of thoughts on that, Peter?
So knowing that I had no idea you were going to present this, and remembering that Mark Twain says, if you always tell the truth, you don't have to remember what you said. I'm going to tell you, you made my day with this chart. And I mean that from the bottom of my heart, because in my own work and what I've been sharing with my friends, and that's all I publish on Twitter for. They are clients, but many of them are friends, and I share my personal observations. It's not investment advice. I have told them that I was expecting this enormous short covering rally in the bond market, which is underway. But after that, I was going to look to get actually short bonds for the first time in decades, because of some of the things you explained, and let me expand on it. First of all, there's something I've coined it monetary heroin. And United States is not the only country pushing it, but we are certainly the leader of it. And anything that's addictive, like heroin is, people become so used to it and feel that if they just get it one more time, then they'll worry about fixing themselves later. And that's what the Fed has done. It has destroyed our fixed income market. And people don't realize how critical that is, because in the planning business that we still do for people that are looking to retire and sell their businesses and what have you, chasing yield has become all but impossible. Junk yields. I never thought this would happen in my career, that I would ever say this, but here we go. Junk yields now are below our inflation rate. And the reason they were called junk to begin with is because they were of high risk, and you only, in a sense, speculated in them. And now even they offer out a return less than the inflation rate. Let me go to the other point that you so quality made, and that is in 2019, because we can't look at last year because of the pandemic, but in 2019, the last year we had, if you want to call it a normal economy in the US, we took in a little over 3.5 trillion in revenue. That's what the United States lived off. It's basically tax revenue. It paid out about $440 billion in interest expense. I don't know, that's 10 or 14%, somewheres in there of it. If we go back to an interest rate of just 4 or 5%, which you're looking at a guy when he went to look for his first house in the early 1980s, and the lady said, I can get you a 15% mortgage, and we thought that was great. Going back to 4 or 5 isn't that high, even though recently it would be compared to. Imagine, if you will, for a moment, that we do go back to that. And a $30 trillion that you pointed out, which is going to be higher by the time the Biden administration is done and the Democratic Congress, not counting, as you pointed out, again, a very good point, why I was so happy to hear it. We have unfunded liabilities in the US somewhere between 50 and $100 trillion. That's Social Security, Medicare, and Medicaid. The United States was smart enough to make it not a requirement in their accounting. But me as a business person, I have to fund unfunded liabilities, which means I have to put money aside for monies that I owe to people or what have you in my business. The United States doesn't have to do that. But we are going to eventually pay those Social Security, I hope to, Medicare and Medicaid. So the real debt level is near 100 trillion. But like you said, let's just look at the 30 trillion. Put a 5% interest rate now, that's 1.5 trillion in interest expense, or almost half of what the United States took in one of its best years, without a dime towards defense, all government things, whatever the case may be. So to see the technical, and I'm looking at the first time, just like your viewers are going to be, Patrick and Kevin, and you're absolutely right. I feel good about my plan. I think once this short covering rally is over, and it could last somewhat longer here in the market, but if anybody has multi-year outlook, I think you have to bet on interest rates going higher and not lower. And so my feeling on you, when you ask me, when you look at this, what does it say to you? It confirms suspicions and thoughts I already had from a fundamental standpoint, and now you presented an excellent technical argument to support it.
Yeah, it's because people, there's swing traders, they look at the daily time frame, but you have to look at the big picture. And if we'd have the data, I have it like the data from the 40s, 50s, it's the same history repeating over and over. Interest rates, they went down and very close levels to today. And people probably back in those days probably said, they can't go up anymore, there's too much debt or whatever. But eventually what happened is the history repeats, right? And always a little bit different. So I agree also, like the technicals are screaming we're going higher, but there's always these narratives that we can't go higher. But
can I say one other thing that's very, very important that came to mind? Forgive me, but it's really important for what you guys do. Technicals used to be described by my great mentor, Kennedy Grandich, and he said technicals is like the guy that invented preparation G. Now, of course, preparation H is the famous thing that everybody uses.
I froze.
But it's always better to be too early versus too late.
Yeah.
And fundamental analysis tends to be more late. People catch on after it becomes, a crowd thinking thing. And by then, most of the move went already. I have to tell you, I was concerned about this because I keep hearing everybody, I guess, like you here in the U.S. markets commenting, oh, interest rates are going to stay low forever. The Fed's always going to print money. As long as the Fed's doing that, interest rates can't go up. But you're right. This chart is a screaming saying we're coming to a divisive turn. And so I think it fits in well to my mind that the next move to do in bonds is to be short, not long.
Yeah, it's fascinating. I mean, I've been staring at these charts for a number of years now, of course, and just trying to scratch my head and work, because I work as a scientist, and I work with facts, with facts and figures and statistics, and I'm aware of how these charts play out over time, and kind of the fundamental reasons why they do that. But just trying to sort of marry that up against the real world and what would happen if this chart plays out in the way that it seems destined to do, which takes me back to precious metals as a lifeboat. Really, you never quite know when you're going to need that lifeboat, but looking at that chart, perhaps time is starting to run out. It's incredible, actually, over the years. You've heard it many times. The kicking the can down the road, and how long can this go on? And but it is amazing just how far that can has been kicked down the road. But something is going to snap at some point, and that chart.
I'm sorry, let me just make one fundamental comment that's the overall picture which plays into all of this. You talked about kicking the can. There's no question in my mind that here in the U.S., we are in the worst social and political era other than perhaps during our Civil War. I don't think there's more of a separation and more people butting heads. There's basically a left and a right. There's no middle. The middle has basically disappeared. And one of the issues why I point that out is, especially political, is in 2008, when we last had our last financial crisis in the U.S., the Democrats and Republicans did manage to somehow get together and formulate something and hopefully move the country out of a dire situation. Okay. I don't think right now you can get that same reaction. I don't think the parties could somehow put their differences aside. I think they would just finger point even more and blame each other for it. The also other part that's important is that can has become extremely heavy. The debt is no longer an 8,000-pound gorilla in the room. It's an 8 million pound gorilla in the room. And the reason it is, if you just look at the federal debt, which is enough, but our states, many of our states are underwater. Several are not going to be able to continue providing services without raising taxes and underfunded pensions. We see that on the same thing on the corporate level. But where I see it mostly and where I get to see it is I sit with families from average workers all the way up to professional athletes making tens of millions of dollars. And I use this number and I know it's right. 7 or 8 out of 10 of American families at different levels of income live at least one level above their finances that should supporting. And when I tell them less is more, they just go down to the street with the guy with the black box with, I can make money and you can live happily ever after. So when you combine all these things, what I think is developing very dark cloud fundamentals, and then you start to see, which really the technicals are pointing to, I have to tell you, I'm 10 times more happier we did this interview than you guys are going to be happy that you spoke to me. So I really appreciate, especially seeing this chart.
That's really heartwarming to hear you say that, Peter. I mean, it's just.
Well, we can all be in the same lifeboat together.
No, I find it fascinating just to see how fundamentals and technical chart analysis kind of matches up and comes together. I know Patrick does as well, and your experience and your sort of thoughts on all this. Hopefully everyone that follows this is going to really enjoy and appreciate. And I know me and Patrick really appreciate you taking the time to join us here and share your thoughts. Is there anything else that you want to sort of just say before we finish the interview? I mean, it's been fantastic chatting to you. I'm over here in the UK, in England, Patrick in Canada. You're in New Jersey. It's just amazing the way technology allows us to be able to do this. So
yeah, this was unheard of 20 or 30 years ago. And it's one of the positives that the internet brings. Unfortunately, there's a lot of negatives. I would just commend, like I said, as I don't have anything to sell unless the person is in the US and they need planning. It's not anything. I just really want to commend you. Certainly if there was, and there wasn't, if there was any doubt that you guys weren't doing a phenomenal job, and that was the reason why I was willing to hear from you guys and so forth. What we just shared today, you made my day. So if I may, I just, I do try to keep my faith out of secular stuff, but if I may, just so I want you guys to know that I'm praying for your success. I hope it continues. And I hope the people that watch this, either through my feeds and all, take the time to go to your classes. I think whatever you're going to teach there, just what little I saw today, I think it's going to be well worth it for the folks. So I really hope that success continues, abounds for you guys, and you'll be challenged, and don't go down the road I did. Don't become a legend in your own mind, and put your pant legs on one leg at a time, and you'll be okay.
That's sound advice. Thank you very much.
Thank you. God bless.
Words of wisdom. Thank you, Peter.
God bless. Take care, guys.
That was awesome. Thanks, Peter.